Okay, guys, this is being recorded. One thing I mention at the beginning of every single webinar is watch this again relatively soon after. Even if you've played around with the long call diagonal, which is what we're going to be doing this one on, my rules are specific to each and every strategy that I do. So make sure when you watch it again that you will have that information sink into your long-term memory. The first time through, it's kind of like you're thinking of questions and I'm talking about a few different things that maybe you haven't learned before. All of that stuff may inline, or it's kind of snowballs and you kind of miss a couple of things here or there, or you just don't remember it. When you watch it again, it will help you solidify all of the concepts and stuff that I'm talking about in here. All right, so medium volatility strategies. This is on the long call calendar. These are all for right now, medium volatility. So in and around where we are right now, we've had this volatility spike. It's kind of coming out, but it's not really coming out really quickly. What we're trying to do is isolate that volatility so we don't have to worry about it going up and down. And with the long call diagonal, you can really accomplish that, especially in the environment that we're seeing right now. I'll go into more detail as to why this environment right now is specifically good for the long call diagonal as we go through this. And usually I talk about long call diagonal with lower volatility, but with this being said, it can really be used across the board into the medium volatility type strategies, because when you get these spikes in volatility like we've seen recently, it really sets up nicely for the long call diagonal. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, and then basically packed my bags after I graduated, moved to Chicago, and started trading on the floor of the Board of Trade. So in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products, and just about every market condition. All right, so got this disclaimer. I'm sure you guys have seen this before, but basically it says any opinions, news, research, and analysis or other information contained here or material provided by Pro-Trader Strategies and or associated companies or employees is to be considered general commentary, you guys. The reason why I can't give you investment advice is because I don't know your risk parameters and I don't know what's in your portfolio. So what I'm doing could be counterintuitive to what you are already doing. So take what we teach you and implement it in your own way. Bottom line is do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can also follow me on Twitter at Wolfman's blog, or our parent company at Pro-Trader Strategy or Pro-Trader Strat. Wolfman's blog, though, that's run by me personally. And what I do a lot of times, especially if I have a trade that I talk about in the daily market commentary, maybe I don't get filled on it by that daily market commentary, which is usually done early in the morning, I'll tweet out what I have done. For example, earlier today, I was talking about a couple of trades that I was trying to take off for about 50% of my max profit. And it hadn't quite got there. Market started spiking and I got out. So I tweeted those out that I was out of my Apple and my XOM short puts so that everybody has pretty clear concept of when I'm getting out, in and out, if you are following along. All right. So like I mentioned, this is on the call diagonal spread. You'll hear me say it a lot. If I ever say call diagonal spread, assume it is the long call diagonal spread. I will not do a short call diagonal spread. The reason why is I don't like selling options that far out on the time horizon, okay? My stance is you sell short-term duration options and you buy the longer duration options. A short call diagonal is just the opposite of my mandate, okay, where you would be buying the shorter duration and selling the longer duration. I don't want to deal with that. So I won't even trade it. I don't even do a webinar on it, to be quite honest. All right, so long call diagonal spread. A couple of things to note with the long call diagonal spread is we are going to be buying it in the money call option in the further expiration. One thing to note with this, and when I talk about the further expiration first is because that's how this long call diagonal spread is quoted. It's quoted from the longer duration. So like right now we have decent January. The January is basically the one that is going to determine this strategy. So when we're talking about it, you're buying an in the money further expiration option and then selling an out of the money near-term expiration option. The reason why is we want to take advantage of the lack of theta decay on this further duration option, and we want to take advantage of that theta decay in this front duration option where the theta really starts picking up and accelerating, eating away at our premium that we sold, which is what we want. We want to sell a higher premium and buy it lower, right? So basically, rule of thumb is we're going to be buying a 65 to 75 days out. Right now, we're kind of about the 50, which will work. But the best case scenario is when we have this further duration right around the 65 to 75 days in duration. And this front one is right around 35 days to expiration. We're just inside of that, which is fine. We can sell the shorter duration. It's right around 22 days here and about 50 days here, which is okay. I'm completely okay with that because the theta decay in this front month is really starting to accelerate. So it will work out nicely. Plus the way the volatility is set up right now, it really makes this a really nice looking trade. All right, a couple of things to know. Market assumption is neutral to bullish. I say neutral to bullish here, you guys, because in the beginning, when we first set up this strategy, we are a little bit more neutral because we want to see some theta decay happen in that front month option that we sold. So we would like to see a little bit slower trajectory to the upside. So in that neutral in the beginning to bullish. So we kind of want a slower trajectory, maybe playing out right now when we put it on and then start taking off a little bit later. But we do not really want a fast move higher right away out of the gates, okay? We want the front month to decay quite a bit. So having said that, if it happens right away, we could see that front month that we sold start increasing in value a little bit too quickly, especially right now where we're seeing the market in a upward trajectory. Anytime we get a spike really quick, we actually are seeing volatility start to expand a little bit. So that is usually not the case, but you know, nonetheless, it can happen, and we are seeing that happen. And it's, you know, not just like a one-time thing. It's been going on for the last month or so. All right, so a couple of essentials to success is picking the right environment. What we want with this is, you know, we're talking about mid-range. You can do this in a lower implied volatility market. I'm not really talking about the VIX when I'm talking about the volatility here, you guys. I'm talking about the volatility for each and every underlying. Every underlying has its own volatility coefficient. That's what we're going to look at to see if that volatility is high for that particular underlying. We don't care about the VIX necessarily. It will help us get an indication as to the broader market's volatility and that, you know, there's going to be opportunity with high volatility strategies. But having said that, with this strategy, the right environment, we want to pick something where the volatility of each and every one, this is what I was talking about, the implied volatility. Every stock has its own implied volatility, and I'll talk about that a little bit more here in a minute. But let's see. With the volatility that I'm talking about here is the options grid is what I want. I didn't want to shut down all of those, the options chain. What I want to talk about here is with these volatilities, okay, this kind of gives us the volatility of Apple, all right? And when I'm talking about the volatility or the environment with this particular one, we're on the environment, right? So environment is volatility in my eyes. And what we're looking for is you look at the volatility in the one that we are going to be selling and the one that we're going to be buying. And we don't want more than a 2% to 3% increase between these 2 months, right? You can see it's actually a decrease to the December, right? Goes from 32.48 to 31.20. That's a decrease. So anytime there's a decrease, that's a green light. A green light to the upside is when there is a 2 to 3 increase. So it would be like between 34.48 to 35.48. Okay, so an increase going to this one. Since we have a decrease, we don't have to worry about it. But on the upside for a green light in normal environments, normal day-to-day, except for recently, usually we'll see volatility increasing throughout the backside as volatility affects those further durations a little bit more. But with the environment we've had, that's gotten a little wanky. People are more concerned about the shorter duration right now, so that volatility is really getting spiked in the near term, which is what I was mentioning earlier on, sets up perfectly for this strategy. You don't even have to think about it, because at the end of the day, what my rule is here with the volatility being between 2 and 3% difference on the increase, going from 32.48 to 34.48 or 35.48 being the high end, that is what we're looking at, because we don't want to pay a lot of money for this volatility out here. We don't want to pay for volatility out here and then sell lower volatility necessarily. We want to isolate that volatility coefficient. But if I can sell higher volatility and buy lower volatility, that's what I'm always talking about, right? It doesn't matter if I'm talking about just doing a naked short call or just buying a call, right? We want to buy low volatility and sell high volatility. And in this case, it is setting us up perfectly. So we don't even have to think about it. We know we're selling higher volatility than we're buying. That makes it a green, almost a, neon green. Is that the volatility from on the at the money option? What we're talking about with this is for the volatility for the monthly. Is that what you're asking? Or are you talking about earlier when I was talking about the implied volatility here? The implied volatility here is based on what the underlying is. And they all have their extreme highs, basically, and extreme lows that are relatively consistent. You can see we've gotten this high volatility here that's higher than normal, where usually it only spikes up to, say, 35, where here it spiked up to 45, 44, something like that. But all of the markets have seen that kind of really extended volatility to the upside recently. Okay. So the next one is picking the right underlying, you guys. Now, when I'm talking about picking the right underlying, we're talking about each and every individual stock, right? So picking the right underlying for me, when we're looking at the options chain, we go into the options chain and we go to the monthlies that are closest to expiration, which is going to be this one. This is the spot month. This is the one where the most amount of trades are happening on any given day. It gets inside of maybe 15 days or something like that, then this is going to generally become the spot month. Okay, so just look at the one that has the most time or the most participation, if you will. And what we do on a stock that's over $100, we take the decimal place and move it 3 ticks to the left. Let's just say this is 18 cents wide. These stock or these at the monies right here, maybe just slightly out of the money, also should be inside of that 18 cents. And as we can see with Apple, that fits that rule. Similarly, on a stock that's under $100, we want to look at something like, let's just say XOM, ExxonMobil. Any stock under $100, basically 10 cents wide to the bid offer. And you can see this fits that rule inside of 10 cents to the bid offer on the spot month. Okay, so that's what we're looking for when we're looking for the right underlying. Now, that is my rule for a green light. Now, if you guys have a stock that you're used to trading, it doesn't necessarily fit this rule, I would just say start calling that like a yellow light. And if you get too many yellow lights along the line here, then you just want to move on to a different strategy. For instance, if this first one, the picking the right environment, was, say 4 cents or 4 percentage points from the bid or from the spot month to the outlier, 4% higher, then that would also be a yellow light, right? We get a yellow light there. The underlying is a yellow light, and we get maybe it doesn't fit the necessary rules for the width of the bid to the, or the width, the amount of money we're paying in regards to the width of the spread. Okay. My rule for this is 75%. So let's say it was upwards of 78%. You're paying 78% the width. So $7.80 on a $10 wide spread. Then that would be another yellow light. You get too many of those yellow lights where it's just over what my high is, then just know that it is getting a little iffy if you have too many yellow lights. But I don't mind you guys stretching it out a little bit to get that. Now, picking the right duration, I've mentioned this already, right? We want to buy the further duration one about 65 days to expiration and sell the near duration somewhere around 35 days to expiration, or the closest to those, okay? Closest to those two numbers. So it could be slightly less, like we were talking about 50 days to expiration on the further expiration and 22 days. You know, that's closest to those two numbers rather than rolling out to the 50 day to short. Does that make sense for everybody? So picking the right duration. So the one that we're buying in the money is a further duration stock. All right. And you can even do that one where you're buying in that further duration. It can have a binary event in it, which is just an earnings cycle, or maybe a trial result for the drugs or something like that. If you're trading financials, it could be the FOMC meeting. Those are binary events. Any event that is known that to affect that underlying, right? And a earnings result would be a binary event, right? So you can buy that further duration in a earnings event. We do not want to sell that one that is close in duration in a binary event, because we expect that volatility to go up for that binary event. And we don't want to be selling into that kind of environment. All right. And obviously, like I mentioned, you have that binary event in the back month, volatility should expand or at least hold on to volatility heading into that, which is good. So what we were talking about with the theta, or the duration, the reason why is because we want to take advantage of this theta decay in this front month right here. So that's the one we're going to be selling, because we want our premium to come out of the one that we shorted. And then we want to hold on to our volatility out here, or sorry, hold on to our theta decay out here. So you can see that our one that we bought will decay slower than the one that we sell. And that's the idea here. On your option chain, the bid, yes, every I see what you're saying there. So JQ is asking about the implied volatility, whether it's for each and every one. Every strike will have its own volatility as well. You can see the volatility, the further out Vega goes away from the at the monies, it gets less, right? So it's not going to, volatility is not going to affect these further out of the money options. So the ones that are closest will be affected more than the ones that are further away, which is the case across the board. Volatility is going to affect the at the monies a little bit more. All right. And picking the right strikes, I've mentioned this several times with the picking the right strikes. We're looking at buying the in the money option around 70, about a 75 delta. And then we're going to be looking to sell about a 36 delta in the shorter duration. Okay. What we're trying to do here is pay for our extrinsic value of our in the money option. Now, remember, every stock has, all of these strikes that are in the money have intrinsic and extrinsic value. Okay. Intrinsic value is what this is worth. So let's just look at the 79 strike. The 79 strike is worth really 6 cents, right? Last trade is 79.06. So out of this, out of this premium, there's only 6 cents of intrinsic value, making what this is worth. The rest of this $1.65, let's call it, is, or $1.60 something, $1.68 is all extrinsic value, which can decay, which is what will go away, right? So what we want to do on this in the money option that we were talking about around this 75 delta is on the further duration. We're going to be looking at further, not to confuse anybody. We're going to be looking to buy this somewhere in the 75 to 85 delta. Okay. That's what we're looking for. I always try and lean towards closer to at the money than the further away. All right. So I'm going to try and go right around this 79. It's right in between. So, that is the one we're going to be buying, right? Now, a little floor trader hack to find out what the extrinsic value is, right? Intrinsic is what it's worth. And going from $72.50 to $79, we have a difference of $6.50, right? So we know that this is worth $6.50. So there's about $1 in extrinsic value that we need to sell off or to pay for, in a sense. So then we go into the closer duration, and I look at this 35, 37 delta, and you can see that's that dollar we are looking to sell, right? So for XOM, if we were bullish in XOM, we've set this up properly. The next thing we need to look at is the width of these spread, or the width of the spread, which is $8, right? We've got an $8 spread here, and we're paying $6.39. We want to pay no more than 75% the width of the spread. So in a sense, we've got an $8 spread here. So what we do is we take what we're looking to pay for it, $6.39, and divide that by the $8, which is the width of the spread. Oops. $6.39, divide that by the $8, which is the width of the spread, and we get 79. So that's where I'm talking about. You start getting a little bit yellow lightish. All right. It's a little over my 75% the width of the strikes. So I might look at something else for this strategy. If I really loved it, I could look at saying, you know what, it's so close. I'm actually buying this under where the current market value is, because if you add $72.50 to $6.39, that should give us our break even, which is $78.89, right? So we're buying this at $79 or $78 below where the last trade is. So we're getting it a little cheaper. But it doesn't make up. We don't want to pay more than 75% the width of the strikes here on XOM. So I'd probably go and look at something else for this strategy, maybe just selling the short puts for the upside on it, because it does have high implied volatility. But I would probably go and look at another strategy. JQ, did I answer your question on the implied volatility or the volatility there? I just want to make sure you're clear of that. Okay, so that one doesn't necessarily work. We could look at, let's go back to that Apple example, because I can look at Apple real quick just to see if it works with the 75% the width of the strikes, which is what we're looking for, picking the right strikes. Picking the right strikes, again, you can go backwards as well. You could look at saying, you know, with Apple, let's just say, you know, 186, you know, if you trade off of Fibonacci and you think, well, I think it might come up and hit this, but hit this Fibonacci, 61.8 Fibonacci, and that'll hold. Well, okay, so what's the closest strike to that resistance area, right? Which is probably the 185. You could pick the 187.5 also. Let's just start with this one. So if I sell this 36 delta, I have $3.15 that I can spend, right? And what I want to do is look for the in the money option here, that this $3.15 will pay for all of the extrinsic value. Well, here's a little floor trader hack for you guys. We're looking at these option strikes. We can just kind of go over here and look. Usually the corresponding option to the one that we're looking at that's in the money, the corresponding, in this case, put, gives us a very good indication of what the extrinsic value of the call is. All right. So it's just a step where you don't have to do all that math. 165 to 79. All right. We've got 14 difference, $14.50 from here gives us, about $3 and some odd cents. It's pretty darn close, to be quite honest, for not having to do all the math. So we'll look to buy that one and see if this math works out. We get the $65 plus the $14. That puts us at $79.75 for our break even. $79.75, right? You do the call, the long call, plus the debit we paid. That's our break even. I haven't gone over that yet, but that's what it is. So we're buying it below where the current underlying is. So we paid for the extrinsic value there. And then we've got a $10 wide spread, $20 wide spread, which gives us inside of that 75%. So we can look at this. We're paying $14.75 and divide that by the $20. That is the width of our spread, 74%. So that's below that 75% that I'm looking for. And that fits the rule. So far it fits the rule of, move the decimal place. We already went over that. We look at the option chain on the two that we're looking at. We can see this is 32 and the one that we're buying is 31. So that's a green light. Remember, my rule for this is 2 to 3% difference, but that's to the upside. That's assuming the upside. Anything negative is a green light. All right. So that works out. That's a good example of the long call diagonal that we're looking for. So picking the right strikes. Make sure that when you're building this out, you start with about a 75 in the money delta, and then you're selling about a 35 out of the money call option in the near duration, right? Now, once you do all that, we need pay no more than 75% the width of those strikes, okay? Doesn't always work out. More times than not, it will, but especially in the environment we're having, where if you are the volatility in the near duration is higher than the volatility way back, it almost always works out because that front month is pumped full of premium. All right. Is the short leg your near-term risk? Yes, your short leg is your near-term risk. But remember, it's not like it's a naked short call because you have the long duration option, which is kind of like having the stock. All right. All right. Know your exit strategy before entering the trade. My rule for this is that once the position reach 50% of max profit, that's when we're covering. So remember, I've been talking about this whole thing, don't pay more than 75%. Well, if we paid, let's just say 75% the width of the strikes on a $10 wide spread, that's $7.50 on a $10 wide spread. Well, our max profit then is the rest of it, that $2.50. So I'm only looking to take 50% of that, which is $1.25. So when my option strategy increases by that $1.25, that's when I get out, right? How does that increase by that amount? If we talk about a $7.50, that's what we paid, $7.50, and it increases by $1.25, then I am going to get out when it gets to $8.75. Now, during the duration of this front month, all right, the one that we shorted, if the market goes up, not tomorrow after we put on the trade, but in a few days, post putting on this trade, if the market goes up and tests your short call in that near duration, you are likely, more than likely, at that 50% of max profit, and that's when you want to cover it, okay? Does that make sense for everybody? I didn't lose everybody on that, right? Okay, good. All right. Or you can do it, you know, if you guys have something else where you had a wide spread, but there was a Fibonacci level right in between that, and you thought, well, I think it's going to go up to that Fibonacci level. My short strike is just over and above that, you know, then cover at that Fibonacci. That's what your trading strategy is. You cover at that price, then get out at that price. Don't change it because I just said, well, you got to get that 50%. You don't always have to. If it doesn't meet with your trading levels, then I would go with those. For me, I'm going to go for the 50%. All right. So your max profit is, I've gone over this a couple of times, right? The width of the strikes, the width of the spread minus the debit paid. All right. That is our max profit. We talked about the width of the strikes being $10 wide and paying $7.50. Then our max profit is $2.50. One thing to know, if that front month expires worthless, right? We let that front month short expire worthless, then it can be considered unlimited to the upside because you have that long call and it can go to infinity and beyond, which I have no problem with. You guys have already paid for the extrinsic value. You don't have to worry about that theta decay anymore, all right? So all you have to worry about is directionality at that point and hope that volatility expands for you. Okay, cover the short or close the spread. Eric, you can do either one. You can cover the short or cover the spread. Generally speaking, I go with just cover the spread if that happens. If my short strike expires worthless, you know, you have a decision to make. You can either ride that out to the upside if it, you know, looking pretty bullish. If it's staying kind of neutral and you're kind of, all right, well, it's really not gone anywhere, but I paid for the extrinsic value. You don't have to worry about that. But I want to lower the basis. You can go out there and sell another call against it after that first one has expired, or roll it out in time. You know, if it's only worth like a nickel, then roll it out to the month that you have gotten long and just create a regular call spread, right? But try and make sure that you're rolling it out and up. You don't want to make that spread narrower, all right? You want to make it wider. And if I have to make it narrower in order to get any type of collection, then most likely I'm not going to roll that out, okay? Because if you have to make it narrower, then it's likely, even with the credit that you received, going to be more than that 75% the width of the strikes, okay? Which I want to stay in line with. Because if I'm taking that risk, I want to get paid off for it. All right. And then our max loss is the debit paid. Remember, anytime you pay a debit for any type of strategy, that is your max loss. And then finally, we've kind of gone over this as well. The break even is that long call strike price plus the debit paid. And I did that several times with the platform. And I'll pull that up here again so that we can go over all of this stuff one more time, just so we're doing it on the platform. I think it'll be a little bit easier for you guys to follow along. And this is also the time where I usually will tell you guys, throw it out there in the JQ's all over. He knew he was ahead of me. In this questions box, throw in there some stocks you want to look at that you're bullish on, and we'll see if it fits the rule. The first one is Micron Technology. So let's look at the charts. Let's just kind of check this out. I like it. It's been overextended to the downside, tweezer bottoms. On the downside as a loser, this is probably where I would get out. If it broke below 33.82, I would be out of this on the wrong side. All right. And also take into account where you would get out on yours. You know, if it's a Fibonacci level, then that's where you would want to get out. Let's just throw up some Fibonacci's here just to see what it looks like. So you can see it's gotten overextended to the downside. I would expect it to come back up into this area. So that's what I'm looking for. I probably want to sell my call somewhere up in here if I have the opportunity. So let's look at that. For one of my, what was the prices I was talking about there? It's somewhere around the 44-ish, 45. All right. So that's one thing we got to look at. Micron Technology is a stock we want to trade. It's under $100 stock. So we want about 10 cents wide. You can see Micron fits that rule, 10 cents wide or better on these options that are just out of the money on the spot month. So that's where we kind of want to start. I usually like to go out here and say, all right, where's that 35 delta? It's around $40. I cannot go out to that Fibonacci probably that far and collect any credit. I could probably go a little further. Let's go to the 41. 95 cents or something like that is what I need to look for in my extrinsic value. So I just usually go over here. All right, well, I'm getting 96 cents here. It says the extrinsic value is about 95 cents there. So that's the one I'm going to buy, which is right there around that 70, 80 delta that I talked about. You know, we want to start around the 75 delta, right? 75 to 80 delta or something. So that works there. So $5.03 is my debit paid. We can figure out our break even easily, quickly. That call that we bought, 33 plus 5 is 38.03. So 38.03, we're a little bit higher than where the underlying's trading. So that kind of puts you over to that yellow light. Everything else has been green so far. One thing we also have to check is the distance or the volatility, right? So Micron in this front month has a 60 volatility. And in this back month, it's a 51. So huge difference. They have do they have earnings coming up? Is that why they have that big of a difference in that front month? So always double check that. You see that big of a difference, then you have to wonder what's going on. And sure enough, there is a earnings event going on in this one that I'm going to be selling. So I don't really want to do that because volatility is going to start expanding on me. So I'd probably back off of that one right away because of just that. And we got our signal from it just because of this volatility. It's so big right here compared to all these other ones that all of a sudden gives me a red siren, right? You know, red light goes up. What's going on? There's something way out of whack there. Usually Wolfman says it gets higher. A good opportunity is when it's higher here and lower here. We have that. But you know what? When I look at this, I can just tell there's something off. It's way too off. And that's because of that earnings event. So boom, I'm out of it. I'm away. JQ is giving me LOL. All right. So Amaro is going out XOM. Let's look. I'm bullish on XOM. I've been bullish on them for a little bit. Let's see here. So get rid of it. Let's look at the front month. One thing, under $100 stock. So 10 cents wide, that fits that rule. Next thing we need to look at is the volatility in line. We've got a 22, let's call it 23 here. And then in our 50 back here, it's 22. So it's lower. We don't have to worry about it. Just double check to make sure there's no earnings. There's not going to be any earnings that we have to worry about. So that fits. Start off. Let's look for that 35 delta. It's about $1 right here. Then I just roll out to the next option montage and say, all right, I've got $1 to spend. Where can I spend it? Right here. And that's, you know, right around that, between that 75 and 80 delta, right? Close enough. So I'll go with it. And $4.25. So $4.27. Add that into this 75. That gives us $79.27. It's right there. We're inside the bid offer. So that's not too bad. Next thing to note is this is a $5.50 strategy. So $5.50, we're going to have to play around with this one to see if we can get it to work. So $5.50, and we have a $4.27. I can tell you right now, it's not going to work. $5 is 85% the width of the strike. So let's play around with this a little bit. Maybe we can go a little bit deeper in the money. Buy this one. We've got to at least pay for 50 cents. Try and go a little bit wider and do that one. So now we have on a $9 wide with a $6.74. So $6.74 and divide that by the $9. It is still $9, right? $9.74. So you play around with those. Don't always just go with the first one. You play around with it a little bit. We got it to work, right? But the idea here is if we are having to pay for that much of the spread, we need to be compensated for it, right? We need to be compensated on the back end. You don't want to be paying the full. And as a matter of fact, sometimes when you will see this volatility in the front month so much lower than the one in the back month in a normal, say this was a 5% difference, it went from 22 to 27 or 28. You could actually see in certain situations where you are paying more than the width of the spread. I've seen it happen before. Make sure you are double checking your width of your spread versus the amount that you paid for it. Okay. So another one I saw, I don't know if I'm going to get to everybody's, Intel. I'll get to IBM here in a second. I'll do IBM here in a second. So Intel is one that we can look at. So let's, here, why? Let me just blow this up so I can get rid of that. All right. So we are looking at Intel under $100 stock. We need 10 cents wide or better, and that fits that rule. All right, so then we're going to kind of go and look at this 35 delta. It's right in between. I'm going to try and go a little further away. I'd rather sell further away and buy closer to the at the money if I can, if it's a perfect world. And then we're going to have to probably go to this 80 delta. So we buy that one. Our break even now is the $4.90 added into the $43 call. That gives us $47.90. So $47.90 puts us right a little bit higher than where it currently is, which is okay if everything else fits. So we'll pull this back up on our calculator and we say, let's say $5 divided by the $6.50. $6.50, $76. Let me just see if it works. If I do the $4, it's going to be closer for sure. $4 by this $6.50. So 75. So that's kind of working. Pretty close for government work. So that one we can work on. That will do it. I'll do IBM real quick. IBM. Let's check it out. This is one of those stocks that I have a position in. I'm not trying to get you guys living off the cliff with me. It's a bullish position anyway. So let's look at IBM. One thing to look at, let's see if the DEIS is higher again, so we don't have to worry about it. As long as the DEIS is higher than the JAN, that's no big deal. If the JAN is higher than the DEIS, it's got to be within 2 to 3 percentage points. So we're fitting that rule. We're good to go. IBM, $120 stock, 3 ticks to the left, 12 cents wide. We got that going on. That works for us. It's inside of the 12 cents there. Look for the 35 delta. That's the 124s here. So we'll sell that one. Go down to the other options, the further duration. We have $1.67 to spend. So we'll start around that 70s, go a little bit closer. And we've got a $9 wide with the $6.50 or $7. I don't think this one's going to work. So $7 divided by the $9 wide, divided by 9, 77. So it's a little bit high. We can play around with those numbers, maybe go a little bit further in the money here, buy this closer to the 80 delta, and then just kind of look over here. I at least get 80 cents. Let's go with this dollar one. So our break even now is 2207. 2207, slightly higher again, but it's not too much. Not too much to make up within any given day. You can see it had moved to $1.50 today. So we figure out our break even, 2207. Like I said, it's a little bit higher. I already did that one. So the next thing to figure out is $16 wide. Have we collected enough for that difference? So $12.07 divided by that $16 gives us 75.4. So that's pretty close. That one will work, Doug. Got to run. Take it easy, JQ. All right. I'll look at Kroger. Kroger sometimes fits the rule of the width of the bid offer, but it doesn't always. So let's just look at it. 30-cent stock, closest to the at the money, it's fitting the rule. So we're good to go there. Next thing we want to do is go to that 35 delta. I'm going to kind of try and go a little bit further out than that 35 here. Give myself a little bit of room, right? So I've got 65 cents to pay off extrinsic value. That's going to put me here. I just look straight over here, say, you know what? That looks good for me. Our break even now is $30.37. That's putting us right in between there. That's pretty darn good. It's a $5.50 wide. So this one's looking pretty good. So it's a $2.87 divided by the $5.50. It is $5.50. Yep. Did I do something wrong here? It's $4.50. So $2.87, $2.87 divided by the $4.50. Sorry, $4.50. So that still fits the rule. Do you ever look at the out of the money diagonal call spreads? No, Philip. I have other strategies that would kind of mimic something like that, but I don't usually do it out of the money like that. When do you get out of this? When do you get out if the stock tanks a little bit or a lot more than where it's at right now? Where do I get out of it? One of the things with me is I look at it as a probability. I have about a 75% probability this is going to still be in the money at expiration. That's pretty darn good odds. If you are a trader, and if I were looking at Kroger on this stock, I would go to the charts and say, you know what, if it broke below this level right here, that's where I'd get out. This down dip. If it broke below the 50-day moving average, maybe, if that's what you do. All right. Kroger for me is maybe one that I probably wouldn't even enter this trade in, just because, there's a lot better opportunities on ones that are overextended, gotten way oversold right now. And that's really where I'm looking to jump in. But if it breaks like a support level, something like the 52-week low would be something if I was buying it down here, or right with this particular stock, if it broke below, say, $29 is where I would get out. Okay. But usually with something like this, I'm probably, if I've come up with a bullish assumption on it, I'm probably going to write it out into the sunset until my directional assumption changes. If it changes, then I would definitely get out immediately, even if it didn't break a support level. If I just heard something on Twitter or on the news and I was like, oh, yeah, that's not good for my stock, I'm out. Just get out of it. Pull the ripcord anytime you want. So if you're talking about, do I buy in the value area here? I actually like to do something like when it's overextended to the downside. And there's a lot of stocks out there that are overextended to the downside. We could even look at Apple, which I can't believe nobody asked for an example. I think Apple's been overdone to the downside. Yeah, they are having struggles selling some phones, but I don't think they're going away anytime soon. It's too difficult to get rid of them. It's too difficult to switch from Apple to anybody else anyway. So people are kind of stuck there. So let's say we got a bullish market assumption in Apple. We've got a resistance up here at 85. I kind of already did this one, didn't I? The 65, 85. So ones we would be selling is the 185s here and then buying the 165s. I already did this example for you guys. In the money, the 165s, $3.15. I'm able to pay for that. We already did that. We're good to go on that one. Somebody else threw out Netflix, so let's look at that one. Probably going to be the last example, you guys, maybe. So looking for that 35 delta, that's 34 is closest to it. So let's sell look at selling the 305s. All right, so I've got $7 that I get to play with. That's my budget. $7.30. So that's probably I'm going to have to go a little bit further down to the 80 delta because I want to make sure I at least pay for all of the extrinsic value. So let's look at the break even on this. It's going to be 250 plus the 38. So we're at 288.78, right? 288.78. That puts us right in between the bidder. That's a little bit lower there. Last was higher. So that's good. It's close enough. I don't want to pay like, $2 or $3 higher. That's the problem. If it's like 25 cents, that can be made up in seconds. So I'm not too concerned about that. The next thing we have to look at, $55 wide. $55 wide spread. We've got $38.78. $38.78 divided by that $55 wide spread, and we've come up with a slow computer. 38.75 divided by the $55, 70%. So we're good there. 71%, 70%. So that works for that one. That's a really good strategy. One thing I forgot to look at was the volatility. It's 52 here, and in the D's it's 49. So right now we don't, still look at it, you guys. Still make sure, because there could be an outlier right now that has higher volatility out here. Just make sure it's tighter. Right now, volatility further out is not nearly as high as we are right now. Okay, so is this set up kind of like a poor man's covered call? In a sense, it is very similar to it. Poor man's covered call is a lot further duration on the one we're buying, but very similar setup in the sense of buying the in the money and selling the next month out. Or sorry, buying the in the money further out, but we're only like 1 month in difference, where calendar gets a little bit further away, or the poor man's covered. Do you do this for puts on a bearish side as well? Yes, Ryan. We'll be going over that as well tomorrow, or next Thursday for you. But right now, you guys, we have an offer for you. It's in the chat window, I believe. Let me just double check the chat window, just make sure it's in there. So this link is in the chat window. This is not a hot link. You can, if you're watching this on tape delay, you can pause it and punch it into your URL. If you're doing what I said and watch it again relatively soon after. If you're watching it right now, though, you can click on the link. This is a great webinar. This is basically a special options trading webinar offer for you guys. There's a ton of videos in here. There's over 10 videos and probably over 10 hours of content here. So take advantage of this, protecting your portfolio against high interest rates. I love this video, you guys, because I think it is something everybody needs to be aware of and being on top of right now. Okay. Protecting your portfolio against interest rates for $36. That alone is worth the money in and of itself. Take advantage of it. You guys learned anything about anything new from me, even if you're an options trader for 10 years and you learn something for $36, you should be taking advantage of this. It's cheaper than some of the premiums you're paying for. And I'm going to be increasing your probabilities of success. So take advantage of it. So if you've enjoyed my instruction or how I teach, especially if you're one of my regulars, click on that link over there in the chat window. We've been going back and forth in the questions box. The link is in the chat window over there on the main go-to webinar thing over there, whatever you call that, drawer. So the best way to become a better trader is to constantly learn, which you guys have obviously done or attending this webinar, but creating consistent results is what I am most focused on. And the only way to have consistency is to be mechanical. And when you're mechanical, the way that I teach, you're increasing your probability. So all of this stuff snowballs into having the right tools in the right situation, which is going to make you more productive. And when you're more productive, you're going to be able to put on more strategies, which creates more opportunities. And ultimately, you are going to be confident where you don't even have to worry about all of this other stuff that's going on. You'll be able to sit and sleep at night knowing my probabilities. All of that stuff will give you peace of mind. And that's how I try to teach. I'm not trying to teach you, hey, this is a great strategy. You got to put it on because of XYZ is going to this. All right. I don't teach like that. I don't know if the market's going up or down. Nobody does. Everybody's going to act like they do, but nobody really does. So the only way to beat that game is to have the probabilities in your favor. Turn the probabilities around so that you are on the right side of that trade. And that's what I try to teach in this. So take advantage of that. It's in the chat window, like I mentioned. And finally, I just want to thank you guys all. I see a couple questions coming up. I think I'll try and get to those here in a minute. Thank you guys. I just want to say in later webinars, I'm going to be drilling down on different option components, trades I find when and where I find them appropriate. There's also a link if you're watching this on tape delay. Again, it's not a hot link. You'll have to pause and punch that into a URL window. And thanks for watching. If you have any questions, you can contact us at 310-598-6677 or trading@protraderstrategies.com. Like I said, this is the link right there. But the easiest way if you're attending this live is to hit the chat window. So that's about it. Other than if you can't take that, take it easy. Thanks, Andrew. Appreciate it. Thanks, Chris. Current market conditions. Can you put a little bit of context around that, Benu? Nice strategy. It can be done when the market is closed since I work during the day. Can it be done when the market is closed since I work during the day? No, I don't think you'd be able. You would be able to put in a trade at night and have it ready for the next day. Yes, that you could do. Like for this trade, I could send that off and put it. I forgot to put it in as a GTC, but put it in as a GTC or something like that so that it goes in tomorrow. Thanks, Philip. I appreciate the kind words. All right. Monday strangled to buy an already big move made. Monday's strangle. I'm still confused, Banu. I don't think I did a strangle on Monday. All right. I'll stick on for a little bit longer, Banu, but